Coming up today, the Bank of Japan blinks, saying they won't hike rates further. JP Morgan says the carry trade's only half done. Has short volatility blown up? Why we could retest the lows? Are we on the verge of a recession? Oil bounces back, and the latest on the Middle East. Let's go, guys. Hey, what's up guys? Welcome back to the Daily Market Review. Bit of a sharp reversal. Off the open this morning, we had a really good rally overnight after hearing from the Bank of Japan, changing their stance, coming out a bit dovish, trying to reduce volatility in their market, saying they won't hike rates if markets are still volatile, which did get the yen to pull back. Just looking at Japanese yen futures here, traded in Chicago. However, we're not completely out of the woods just yet. I'll show you some research from JP Morgan soon, in which they say we're only halfway done through this yen carry trade unwind, and so markets continue to trade a little heavy here. We can see a lot of red on the market color. Only thing we've got green across the board is volatility, but we are getting a little perk up in long dated yields and oil, and high yield bonds still holding in there pretty good as well. Stick with me today because I'll show you an under the hood look at the US economy and credit market. We can see what's actually going on out there outside what we're seeing on the charts here. However, things aren't as bad as they might seem just yet. Just looking at my market risk on, risk off indicator, which shades the entire chart either green or red. Green for risk on mode and red for risk off mode, which we can see here. Last triggered a clustering in September and October last year. A lot of things go into this indicator. Market breadth, options market, high yield bonds and the like. Just to give an indication, if the market's on shaky ground, to be cautious, maybe wait for risk on mode to come back again. And sometimes it can give isolated false positives. Just looking back in history like here, you'll typically see that either 1 or 2 days, as it can be a little sensitive sometimes. However, sometimes it gives you a thick reading like we saw in September 2022. And it can give you early indications when the market structures change, just like we saw in early 2022. We see clustering of this risk-off indicator, and it kind of persists. That can let you know the market has structurally changed. And just looking back in history, it was risk-on all of 2021, gave a few false positives there in October 2020. But going back into COVID, you can see it went straight into risk-off mode as soon as the market just came off those highs. Just looking back in late 2019, the market was on a tear. Parabolic, grinding higher, economy was good, expectations were good, and we started getting news around here of the virus escaping from China. Then the market kind of really woke up to it come the 24th of February, and then my market risk on, risk off indicator went into red and stayed there all the way until late April, where it let us know markets had stabilized and were back to risk on mode, which it stayed for a long period of time. My point is, it hasn't even flickered on yet, so a lot of market internals and structure are just not deteriorating. It was more just a crazy abnormal print we got in the VIX. And again, stick with me because I'll show you some data later on that shows just how abnormal Monday was in the volatility market. There was quite a lot of dislocation, really wide bid-ask spreads. S&P options gave us that crazy print of 65, which was kind of a record compared to the market fundamentals. The most volatility we got when things aren't really that bad out there, as I'll show you a bit later on. And so just looking at the candlestick we got today on the S&P 500, it's pretty much a bearish engulfing candle, which suggests the market tried to bounce. However, it was overwhelmed with selling supply. But just going down a 15-minute chart on the SPY, there are strong signs of the dip being bought. Doesn't mean we can't go lower. However, there is big money out there waiting on the sidelines, ready to snap up any low prints we may get. And so that was Monday's open right there, 511 on the SPY. And if I just focus in on my DSI indicator, you can see right from that open on the 5th, a pretty big bullish divergence going on here, even though we're almost back to that level as I speak, trading a bit above 517. So I think it's likely we at least come down and test those lows from Monday, potentially tomorrow, if not going into the weekend on Friday. And like I've been saying, I'd actually be surprised if we don't see 5,000 or maybe a peak below that in the coming weeks, month or so. That would kind of be the best case scenario in my opinion. We do have a bit of weakening breadth looking at the percentage of stocks above the 200-day average. Still more than half. However, it is making new lows for the year, which is not a good sign. And once again, we've got stocks hitting new 52-week lows, outpacing those making 52-week highs. Still got a bit of backwardation in the volatility market with the VIX 9-day higher than the VIX 30-day, even though we don't have any big pending economic prints due out, showing that option dealers are still forecasting near-term volatility. Often when we get big spikes like this, it doesn't just go all the way back down to 15, 12, and stay there. It can hover around, maybe do a little retest. Then there'll eventually be a VIX crush, like what we saw after April. You often see this in the VIX. When it falls off, it just falls off hard. However, for that to happen, actual volatility in the market has to drop off, and that's still quite elevated here. Realized volatility tracking a bit under 19% annualized rate, and of course, stocks are starting to move together again. 32% on implied correlations. We got government bond yield stabilizing with the 2-year just below 4%. It's a good sign to me for the 10-year bond yield climbing back above this support zone, 395. There's TLT pulling back. Remember I told you guys late last week on Friday going into Monday's open, people would be chasing that. However, my DSI pointed out it was very overbought, and that's why it's usually best to buy pullbacks or consolidations in a new trend. So TLT could be setting up for a dip buy as we approach the 50-day VWAP for sure, with the tailwind and high likelihood that the Fed's going to cut rates should offer a lot of support in long-dated bonds. The other good sign is we had high-yield bond make higher highs and higher lows today, trading above the 50-day VWAP. That's a good sign for credit markets. The dollar as well stabilizing, and there's the Aussie yen. Like I said, I was looking for that to stabilize, perk up a bit, volatility to come down. By no means are we out of the woods just yet. We definitely could retest this hammer wick. However, the Bank of Japan has already signaled support for the markets, so that's a fundamentally good sign as well. Bitcoin's still on loose ground, $55,000 a coin, as is Ethereum, retesting this hammer wick as I speak. Gold's still pulling back on low volatility, and there's crude oil bouncing off support today, and I'll come back to that later as well. Just looking at the largest stocks in the market, bearish candle there for Microsoft, still technically oversold here. Apple doing surprisingly well after we got news. Buffett trimmed his stake in half, holding on. Amazon still trading pretty heavy, trying to find a low. And interestingly on Tesla, pretty low volume here, which we can see in the summer months, and that can sometimes exacerbate moves. Wider bid-ask spreads, less liquidity. However, we're seeing more heavy trading in semis. Like I said, key sector to watch here, NVDA putting in a bearish engulfing candle today after we got that bad earnings report from Super Microcomputer yesterday. Finished regular trading down 20% today. Pretty big volume after they had a huge EPS miss yesterday, 23%. Like I said, I'll be looking for this zone around $400 where it broke out from that long base to be defended, because this has been one of the best performing stocks related to the whole AI boom. And so you could kind of think of these smaller hot stocks as like the canary in the coal mine. When they roll over, pretty good sign the sector's rolled over, and we'll just have to wait and see if the semi and AI sector does roll over. Is it going to pull the entire market down with it, or are we going to see big rotation? For now, semis are weak across the board, just after we got Intel hammered last week as well after their bad earnings, down 26%. Stocks now trading under $20 a share on a market cap of only 80 billion. Pretty sure NVIDIA moved more than that in market cap just today alone. And got some other hot stocks in this market. Eli Lilly still trading down, which we get to hear earnings from them pretty soon. And we've still got defensive sectors like utilities holding up, along with REITs as well. Okay, so you might be wondering, is this yen carry trade unwind mess over, or is there still further to go? Well, obviously the Bank of Japan didn't like what they've been seeing lately in their stock market and have come out to calm things down by saying they won't keep hiking rates if this volatility persists. And that's what the market was really worried about. Not only just that initial move off rock bottom to 0.25%, which I guess the first move was always going to rock markets, initiate a bit of an unwind, just because that percentage increase off the rock bottom with leverage can really magnify moves. But it was also the market worried that the Bank of Japan is going to keep hiking rate, and that's what caused a lot of people to bail on the trade, and then kind of momentum just takes over. And there's a look at Nikkei futures. Their stock market had a pretty strong bounce off their Black Monday. Things look to have stabilized for the here and now. However, we've got JP Morgan saying the carry trade that pummeled markets is only half done. They think Japan's going to have to keep hiking their rates, otherwise they could potentially have problems with inflation, and at some point they needed to normalize them and catch up with the rest of the world. And so they're thinking once things cool down again, the Bank of Japan will come out and continue hiking, which means this yen carry trade unwind may not just be a days long thing, but could turn into a months long thing, and who knows, even a years long slow unwind. However, not everybody will be unwinding their yen carry trade, like Warren Buffett, who a couple of years ago sold a lot of Japanese bonds and turned around, took that money and invested it in 5 Japanese stocks. Large caps trading really cheap, single digit PEs, high dividend yields, just real 1-foot hurdles, as he likes to refer to them. However, unlike other traders and hedge funds, Warren Buffett doesn't lever his company to the hills. He always stays well diversified, and the debt he sold has actually got some maturities all the way out to 2060. So he won't have to cough it up, and the good thing about being short bond and long stock is that he's hedged out his currency risk. And the cost of servicing his debt through the bonds It's less than 1% a year. That's why the late Charlie Munger said it was one of Warren's best trades ever. Current value, a little over $20 billion. What about short volatility? Is that trade dead now? Like Volmageddon, February 2018. A lot of traders' funds, even some electronic traded notes, ETNs blew up. Even though we got a sharper spike in the VIX, looking at percentage changes in 1, 2, and 3 days, didn't appear to blow up as many funds this time as it did last. I think the market and systems actually become a bit more resilient from that and has learnt from that, just like the financial system learnt from the GFC. And the whole system was able to prevent commercial real estate blowing anything up, be able to swallow that risk pretty well. So I don't think the short volatility trade is dead. History would suggest that now is actually a good time to sell volatility. That is, of course, if you know what you're doing and you do it within your risk limit. Because nobody knows for sure. It could have a lot further to go. However, the volatility of the volatility index, VVIX, around these levels, looking back in history, it doesn't really stay above there for long. And that's the price of options. So options are very richly priced at the moment. And so selling puts on stocks you don't mind owning at the strike you sold definitely looks appealing here, given how elevated premiums are. However, it doesn't mean the market can't trade lower over the coming days and weeks. According to Ned Davis research, they say history suggests a retest of those Monday lows is likely, as we've only seen an 8.5% pullback from the S&P 500's highs. Given the macro backdrop, we shouldn't be surprised to see 10%, 12%, or 15%. However, like they point out, if we don't see signs of an imminent recession, the market could have a pretty good bounce. But just to show you a visualization of what an abnormality Monday's VIX was, just this scatter plot here. On the x-axis, you've got the VIX daily change in points. There's 0, 5, 10, 15, 20, -5, -10. On the y-axis, you've got the S&P 500 daily change in percentage terms, 0%, 2, 4, -2, 4. So you can see most of the time when the VIX goes up 2, 3, 4, 5 points from yesterday's close, the market's typically off 1%, 2%, and get those few outliers, market off 4.5% when the VIX is up 4 points. On Monday, August 5th, the VIX was up more than 15 points from the prior day's close. Market was down about 3%. Then yesterday on Tuesday, it flipped completely. The VIX crushed about 11 points, while the market bounced about 1%. And again, just another example of the fat tail prints you get in financial market. And so for sure, markets are on loose ground here and now. We can see that in the median bid-ask spread in S&P 500 stock. That's the difference between the price of the best bid and the best offer. And in times of market distress, that'll always widen. Market makers widen their spreads, demand more of a premium to compensate for elevated risk. However, it's not at those levels we saw back in COVID. Markets were really loose. And again, just looking back in history at the distribution of S&P 500 maximum intra-year drawdown. So here we are now, having done about an 8% drawdown. That's in between the 5 and 10% mark, which we'll do about 35% of the time. However, a quarter of the time, we'll do a 10 to 15% drawdown, which I think there's a good chance we'll do that this year. And even potentially a 15 to 20% drawdown. Like I said, if we get to 4,600 on the S&P 500, that'll be about 17, 18% drawdown. And so that shouldn't be too surprising either. Like I said, if we can defend 5,000 on the S&P 500, that would be the best case scenario. And again, just looking back in history at election years, they typically do pretty well. Down the bottom is the outlier, 2008. And so even though it was an election year, that was the global financial crisis, kind of overwhelmed everything there. If you take out that abnormal print, then looking back in history, there's only 2 election years when the market finished lower. And up until early July, we'd been the best performing election year. Definitely got a bit ahead of ourselves. We're having a healthy and normal expected pullback, whatever the reason is. There's always a different reason. However, the closer we get to 0%, looking back in history, that should be a buy the dip opportunity, because a lot of the time the market can recover, especially going in towards Christmas. However, I'm seeing comparisons like this on social media. Someone posted today, side-by-side chart of 2020 COVID, like I showed you early on in this video, 2024. And sure, there are some similarities going into it. We were trading pretty hot, just like we were in late 2019. Markets did break apart all of a sudden, just like we've kind of done recently. And who knows, I'm not saying this is not possible. We get down to 4,300 on the S&P 500 by October. However, unless we got any new real surprise, like hopefully not a large global war or some other big external shock, if this was all just on further unwinding of the yen carry trade, market makers just kind of pulling their bids and offers, and the economy was still holding up, that would be a gift by the dip down there at 4,300. On the other side of the coin, and if you want to hear the bullish argument, then just check out the latest from Tom Lee and Fundstrat, who say the sharp reversal in the stock market's fear gauge is the worst is over for investors, with the VIX hitting its 3rd highest level ever on Monday due to a violent unwind of the yen carry trade, with Tom Lee saying the degree of the VIX reversion since then shows the worst of the scare is over, with him pointing that historically large declines in the VIX lead to sizable stock market gains, with past instances showing a year later S&P 500 can increase 37% on average, and points we still could be in a Goldilocks period of a soft landing, inflation pulling back, with the jobs market and economy just softening a little bit, that it doesn't go into recession and it can instead enjoy lower interest rates. Potentially the same setup as 1995 when the Fed was cutting rates. We didn't go into a recession. A lot of people, including Alan Greenspan, thought the market was irrationally exuberant. However, it went on to rally for another 5 years before eventually finding a bubble top. And just looking back in history at the S&P 500 performance around major VIX spikes like we saw on Monday, down the bottom here is the weeks around the event of that VIX spike. Over the next month or two, we can definitely still see some elevated volatility. Market bumping around a bit, trying to find its footing. However, like history shows, buying extreme fear can historically pay off if your time frame's longer than 2 months. Looking out 6 months, 12 months, markets can often bounce back after those big VIX spikes. And we can see that in this data here. The next 12-month return of the S&P 500 based on different starting VIX level. See, the best returns come when the VIX is either really high or it's low. When it's more than 33.5, going forward, on average, the market will slap on 25% in the next year. And so this is the VIX split up into 20 buckets. Funnily enough, the worst returns come when the VIX is in the low mid-20s, kind of where it is now. So that spike we had up on Monday was a good time to buy. And then if the VIX can drop back down into the teens again, that's historically a good time to be in the market. And just getting over to the bond market, we did see a bit of a rise in treasury yields today after a weak 10-year note auction, with a lot of corporates selling bonds as well, adding to the supply out there that needs to be digested by the market. And so according to Goldman Sachs, the Fed does have to worry about the stock market impact on the economy. And it's true. Sometimes the tail can wag the dog when it comes to the market and the economy, even though it should always be the other way around. The market should be trying to price what the economy is going to do next, 3-6 months out. And then if it's wrong, it can reprice. However, sometimes you'll see things get so bad in the markets that it has a wealth effect. People see their portfolios coming off a lot. They can pull back their discretionary spending. Businesses can pull back investment and can kind of create a halo effect. And so Goldman Sachs estimates that a 10% stock market sell-off could reduce US GDP growth by 45 basis points over the next year. And I'd say that's a fair assessment as well. And so sometimes markets can actually just talk themselves into a recession. If everyone sold like crazy and we all crashed the markets by 30, 40, 50%, then we're way more likely to go in a recession because all of us will be pulling back our discretionary spend. However, I agree with Goldman in that there's no immediate need for the Fed to step in here with an emergency cut. And I still think they could very well just cut 25 basis points next month, which is definitely a contrarian view. However, just looking underneath the surface at some other indications, shipping, how much goods have been moved around the world, pretty good indication of economic activity. We've got the CEO of shipping giant Maersk saying there's no sign of US recession in freight demand, with him saying US inventories are not at a level that is worrisome or that seems to indicate a significant slowdown right in the offing. With him going on to say we've seen in the last couple of years actually the shipping container market remain surprisingly resilient to all the fear of recessions that there has been. And we just heard from Jamie Dimon with him saying that investors overreacted and he still has his recession odds about the same, which he gives about 40% chance of happening. He's still skeptical that inflation will come down enough to meet the Fed's long-term target of 2%. And he said as long as employment levels remain healthy, banks will continue to have strong balance sheets. And even the respected economist Claudius Sahm, the inventor of the Sahm rule, which is a recession indicator, which basically just shows another way of the unemployment rate starting to trend up, has said that her rule was meant to be broken, doesn't see immediate signs that we're going into a recession. She said her Sahm rule is still relevant, the risks of recession have risen, but the economy is still growing, just at a slower rate, and there's been external factors that could have played a part here, like COVID throwing a lot of numbers out of whack, jobs market normalizing, a huge influx of immigrants into the United States, Hurricane Beryl, and quite a few things. No indicator's right 100% of the time, and each setup kind of has its differences, which we can see in this data here, and recession indicators before triggering the Sahm rule and their average change over 4 months. So we had recessions in 1990, 2001, 2008, which the Sahm rule predicted. However, before the Sahm rule triggered, non-farm payrolls, personal income, industrial production had all been trending lower. We just don't have that right now. In fact, we've had some bullish signs of industrial production of late. Credit markets are usually quite sensitive to changes in the economy, and you'll see that with high-yield bonds. The yield that investors demand significantly increases over treasuries, along with the premium required to insure them, as displayed here in credit default swaps. They've definitely increased lately, but nowhere near crisis levels. You'll always hear there's a lot of debt out there. people are drowning in debt, and for sure, that's true in some cases. However, just looking at the entire economy, it's nothing like that real estate bubble, subprime crisis going into 2008. Just looking at the percentage of household debt versus GDP, about 63%. And with the way banks are capitalized now, way less leverage and risky bets, it's nowhere near the same setup as 2008. And even though we do have a rise in credit card delinquencies, mostly in the millennial age bracket, currently just below 11%. Again, what's different from the global financial crisis and the weak years we had following that, 2009, 10, 11, in the economy, is going into that. We had credit cards, student loans, mortgages, auto loans, and HE revolving loans all increasing going into that and quite elevated during that period, whereas they're all relatively quite low now, except for credit cards. And so markets freaked out last week with that surprise jump in the unemployment rate to 4.3%. However, that too has some external factors affecting it, like Hurricane Beryl, record amount of people that couldn't work in July, and so it's not all as bad as it seems. When just looking at headline prints and media headlines, so we can see that in the total amount of US layoffs and discharge rate, it's actually right down at its lows. And that's the amount of job cuts, people being laid off, fired, not hired. It's just simply not increasing. It's down near the lows. Another good news, inflation is still tracking down as well. We can see that in the trueflation rate, 1.41%. And so they kind of look at a wide, broad basket of things. The prices on Amazon, Walmart, to gauge what a true inflation rate is. And so that's tracked down sharply these last couple of months, meaning the Fed can definitely cut rates here. And there is still the possibility of a soft landing. Inflation coming down, jobs market just softening a little bit. However, according to the Atlanta Fed, their latest GDP forecast for Q3 is at 2.9%. For us to be in a recession, we'd have to see third quarter GDP coming negative, just like it would have to in Q4, firmer recession. So that's quite a ways away. And just looking at the latest research note from Goldman Sachs, they said we don't see broad-based evidence that an acute deterioration is underway in either the labor market or in market function. And they said despite tweaks to our Fed forecast and recession risk assessment, our baseline outlook is still consistent with a central case where the 10-year Treasury yields are centered above 4%, which is kind of what I'm looking for as well. This area down here to be defended. For a sign the bond market thinks the US economy is going to be okay. It's kind of the sweet spot between 390 and 470. A good note from Bank of America research today as well. What wealth giveth, wealth can taketh away. A reminder that asset prices don't always go up. Financial conditions have not tightened materially, nor has financial stress increased, but just given a timely reminder that we can see volatility in markets from time to time. Still making our way through the back end of Q2 earnings season. Just heard from Warner Brothers, posting a whopping $10 billion loss after they took a $9.1 billion impairment charge. Tied to the plunging value of linear networks, the direct-to-consumer business reached 103 million subscribers globally, with Max now available in 65 countries, and the loss came in way heavier than what analysts had expected. They were expecting 27 cents, came in 407, did a huge write-down, and no surprise, stock getting whacked after hours, down 10%. We also just heard from Disney, with their streaming unit, Disney Plus, Hulu, ESPN Plus, finally becoming profitable a bit earlier than expected, still only 47 million in operating income. Not doing too bad at the box office either, with Inside Out 2, Deadpool and Wolverine also getting back to profit since early 2022. Got some challenges in the theme park, income falling during increased costs, softening consumer demand. Overall profit, $2.62 billion for the quarter, revenue rising 3.7%, raising their full-year adjusted earnings forecast to 30% growth. And so it looks like Bob Iger is still trying to orchestrate this turnaround after their shares have been pretty weak for a few years now. Kicked out the previous new CEO. However, they've still got a long way to go, and the market isn't really giving a positive reaction to that report. Pretty much trading flat after hours, around $85 a share. Did start the year well, however it's pulled back sharply. Just over to commodities, we got a nice bounce in crude oil today off those support levels, as we just got a fall in US crude inventories. And I'd say the market may be finding support because it's still on edge on what's about to happen in the Middle East. However, helping to keep a lid on it, and why I think it's likely to keep consolidating, is the US is simply producing it like it's never done before, hitting a record 13.4 million barrels per day last week. And so with the market still on edge over demand worries, potential recession, not seeing the bounce back in China that it's like, we'd have to see a real spillover in the Middle East and potentially affect the actual flow of crude coming out of the Middle East, which still sells over a third of all their supply to the West, for oil to really spike here, especially going into a federal election. The Biden administration has shown that it will release and threaten to release a lot more out of the Strategic Petroleum Reserve if we start creeping towards $90 a barrel. So for sure we could see $80 a barrel around the corner. However, the market's just not all that worried about what's going on in the Middle East right now. Gold had been pricing some geopolitical risk, even though it's pulled back for a few days. And just looking at the inflation-adjusted price of gold, back in its last bull market in the 1970s, when we had a couple of waves of inflation, a few recessions as well, inflation adjusted from about $300 an ounce to $2,600 an ounce, and we still haven't taken that out in this most recent bull market. In fact, we're still below the highs from 2011, that last long bull market we got in gold. Another potential bullish catalyst for the precious metals market is there's strong tailwinds for silver, which can benefit from the huge electrification of the world. Electric vehicles, AI, also surging industrial and military demand, with some experts saying that demand might consume the entire silver market by next year. It's being increasingly used in high-tech industries, electronics, solar panels, automotive sectors, defense systems, aerospace applications. Silver mining output is decreasing with few new discoveries and costly exploration efforts. So like a few commodity markets, uranium, copper, and silver expected to be in a supply deficit for many more years to come, potentially sending it into an epic bull market as well. And precious metals may just hold up the best if we do see a full-blown war in the Middle East. However, Iran could potentially be getting some cold feet here. We're in midweek now. We were already expecting a response from them. However, US diplomats have been trying to cool them down, and maybe their military leaders are just all sitting around their meeting tables looking at each other, thinking if we go ahead with this, we may not just be here next week, because if one of their missiles did make it through Israel's advanced Iron Dome defense system and managed to inflict significant damage on Israel, then just looking back in recent history, Israel has the ability to make high precision attacks within Iran that they can't defend against. They can take out single individuals with a high level of precision. However, we won't know until we know, because we do have signs of Iran blocking its airspace for so-called military activities. There is signs they're prepping for something. However, they may just instruct Hezbollah to attack Israel just so they can save face, give some sort of response, and they may just not go ahead with a full-blown attack from all fronts, because the US military has postured itself pretty firmly in the region, signaling the potential for not only a defensive campaign, but also an offensive campaign should it be warranted. And we can see that in this image here of just US Navy assets in the Middle East at the moment. Multiple carrier and strike groups sitting right on Iran's doorstep, the back of Saudi Arabia, and right in front of Israel as well. This is on top of already more than a dozen military facilities the US operates in the Middle East as well. You're looking at all these air bases here in the red, naval facilities in the blue, outposts in the green, and a radar facility as well. All sitting there right on the doorstep of Iran. So the US is looking to defend their bases as well, if Iran want to attack them, or if they just want to attack Israel along with their proxy groups in the region as well, then they might just be getting worried. What are all these air bases and US Navy assets going to do in return to them if one of their missiles gets through? They've already seen what's happened to more than a dozen of their military leaders this year, so no doubt they'll be making some careful calculations right here. There's a look at the economic calendar today. Not much out. There's oil inventories coming off a lot more than expected. Tomorrow we'll just be looking at initial jobless claims. That comes in a lot different than expected. 240,000 people filing for jobless claims. Maybe that could get the markets moving. However, that's pretty much all we've got to work off this week. There's literally no big economic prints out from the States tomorrow. We will get the unemployment rate from Canada, expected to come in at 6.5%. So there we are, guys, for this Wednesday session. Bit of a bearish engulfing, showing the market still trading heavy. We will have some support levels being tested soon. Do have a few signs of weakening in market breadth. Volatility is still obviously elevated. Bond yields are stabilizing. High yield bonds, credit market still holding up. Bitcoin commodities still a little soft and pulling back. And of course, important sector of semis, NVDA, still trading pretty heavy as well. As always, we'll see what tomorrow brings us, and I'll break it all down again for you guys. Thanks very much for tuning in, and I'll see you again tomorrow. Cheers.